Now suppose that we change the scenario a little bit. And suppose that the next day the market did not adjust to our perception of volatility, but the underlying stock price went up by, say, $2. If the stock price goes up by $2, the delta tells us that the option price will increase by $1. So, if we were completely unhedged, the option price would go from $5 to $6, and we stand to lose $1 times 1,000. If we're hedged, what happens? Well, we've got 500 shares. And if the stock price goes up by $2, we stand to profit exactly $1,000. See what's happening here? The purchase of the shares is providing an offsetting cash flow to fluctuations in the underlying commodity, which is our stock. So we are protected from the situation where if the stock price goes up, we would be losing on our purchase of the option. And then suppose the next day the price of the option adjusts to the 12% implied volatility and the underlying stock doesn't move, then we'll realize our profit of, say, $1 times 1,000. So it's very important when you go into the options market to think about hedging, especially if you go in with a perception that the volatility is lower or higher than the market implied volatility. It's critical that you do not take a so-called naked position in the option. That what you'd want to do is, in our case where we're selling the option, we would buy shares to protect ourselves against unanticipated movements. Now the second example that I wanted to go through had to do with just a plain hedging example. Now we've gone through bond options, and let's revisit the bond option. And let's set up the same sort of example that we had before, where we had $1 million of 20-year bonds with 8% coupons, modified duration of 9. In the option market, we've got options on the identical type of bond, 20-year bond, modified duration of 9 with an 8% coupon. Now, if we purchase an option that we're going to hold to expiration, then we would exactly go for $1 million worth of the put options. If we have a shorter time to expiration, for example, 1 month, then this strategy is not necessarily the best strategy, and we have to take the delta into account. Now, with the delta for a put option, the delta is always negative. So the formula actually for the delta of the put option is the delta of the call option minus 1. So it's not just the opposite of the delta of the call option. It's the delta of the call option minus 1 equals the delta of the put option. The delta of the put option is always negative. And this means as the underlying commodity price goes up, the price of the put goes down. And suppose in our case that we're looking at a 3-month option, but we only want to hedge for 1 month, and the 1-month option is not available. The delta is 0.5, which means as the underlying commodity, in our case the bond, goes up by $1, the put option will decrease in value by 50 cents. Now, what do we do here? Suppose that we undertook the so-called naive hedge. And this would be a hedge of doing put options on $1 million worth of Treasury bonds. Now suppose that the bad scenario occurs for us, where the interest rates go up by 1% and we lose $90,000 on our underlying portfolio bonds. What's going to happen to the put options? In our previous examples, we've been holding the put option to expiration. If we held it to expiration, and if nothing else happened, the profit would be $90,000. But we don't have the luxury of holding to expiration because we need this hedge over 1 month only. Well, the delta is 0.5, and that's what we have assumed. So this means as the interest rate goes up by 1% and the actual bonds drop in value by $90,000, the put option is going to profit by only $45,000. So on our portfolio, we'll lose $90,000. On the put options, we gain only $45,000. So you can see immediately what to do and the usefulness of the delta. If the delta is 0.5, it means that we need to undertake $2 million worth of put options. And then if the interest rate goes up and the bond price goes down, we'll have an offsetting cash flow that's closer to what we're going to lose on our market portfolio bonds. So the delta tells us the hedge ratio, the ratio that we need to do in terms of protecting our underlying portfolio. So this adds another level of complexity in terms of what we did for bond hedging, where you have to match the durations. The durations give us a ratio for hedging, and the delta also tells us additional information as to how much we need to do in the bond market.